Next week, the Federal Reserve Bank is going to be meeting again right after the election to decide what they want to do with interest rates. And Wall Street believes that the Fed is going to cut interest rates again because number one, they believe that you no longer have to worry about inflation, and number two, as a way to continue stimulating the economy. But over the last few days, we got a new inflation report and we got a new economic report which said that inflation came in a little bit hotter than expected and that our economy is still growing fast. So let's break that all down, because yesterday's new inflation report said that core PCE inflation rose by 2.7% over the last year, which is a little bit higher than what Wall Street expected. They expected 2.6%, but it came in at 2.7%. Now, when you look at that, you might say, well, Jaspreet, that's not that much of a difference. But what you want to pay attention to is that number one, the inflation number came in hotter than expected. And number two, it's still higher than what the Federal Reserve Bank wants. Remember, the Federal Reserve Bank wants to see 2% inflation. But if you're seeing 2.7% inflation, which is higher than where they were hoping, that's moving in the wrong direction. And remember, this inflation is on top of the inflation we saw in 2023. It's on top of the inflation that we saw in 2022. It's on top of the inflation that we saw in 2021. That's why this inflation rate matters. Now you might be wondering, what is PCE inflation and how is that different than CPI inflation? PCE inflation is what the Federal Reserve Bank prefers to look at, and it's a little bit broader than CPI inflation. CPI stands for the Consumer Price Index. That looks at the prices of things that consumers pay for. So if you go to Chipotle and buy the extra guac, that number shows up on the CPI number. It also shows up on the PCE number, but the PCE number also takes a look at things that are paid for on behalf of consumers. That doesn't show up on CPI. What does that mean? Well, I have employees at Briefs Media, my company. Those employees get health insurance covered by the company. So my company, Briefs Media, pays for the health insurance. That health insurance does not show up on the CPI number because the consumer, the employees, are not paying for it. It's being paid for by the employer. So the employer is paying for it on behalf of the employee, and because the employee is not paying for it out of their pocket, it doesn't show up on CPI, but it does show up on PCE. So PCE takes a look at the prices of things that are paid for on behalf of the consumer by somebody else. Plus, PCE inflation also takes a look at the rural prices of things, where CPI focuses just on urban consumers. PCE looks at consumers that are urban and rural. That's the difference between the two. And yesterday's report showed that core PCE inflation came in slightly hotter than expected, which brings us to part number two, which is what's going on in the economy, because the most recent economic report said that our GDP grew by a 2.8% annualized rate in the third quarter of 2024, which is still very fast. And of course, we've also been seeing a similar boom in the stock market, where stock prices have been booming. Over the last few days, we saw many indexes in the stock market break new record highs. The Dow Jones, the NASDAQ, the S&P 500 have all been booming. So anybody who has been working on Wall Street or who has money in the stock market has been seeing a lot of growth over the last few years. And part of the reason for that is many people are excited by this idea that maybe inflation is not something you have to worry about. Maybe the economy is going to keep booming, and maybe the Federal Reserve Bank is going to continue stimulating the economy, but you also have to pay attention to what's going on in the job market. But before I talk about that, I want to remind you that if you are an investor in the stock market and you're looking for research, you're looking for more data, you're looking for more investment opportunities delivered to you, my team at Briefs Media publishes an exclusive report called Market Briefs Pro once a week, where we look for market shifts, we look for things that are changing in the economy and how that creates investment opportunities, and we deliver it to your inbox once a week. If that's something that you're interested in and you have at least $500 a month to invest, then you can learn more and apply for a content demo by clicking the link down in the description below. Now, if we take a look at the jobs numbers, we have a mixed report here, because we just got a report that said that layoffs in the United States in October fell to a 3-month low. And it would have been even lower if it wasn't for companies like Boeing, which, if you've been following the financial news, Boeing has been struggling a lot, and this has been going on for a number of years. And so Boeing has done a lot of layoffs, which contributed to that number, but still it was the lowest number of layoffs in 3 months. But on the flip side, we also got data which said that the number of people that are still drawing unemployment checks after 1 week is now at a 3-year high, which kind of gives the indication that maybe more people are unemployed for longer. Now, there's been a lot of potential reasons for this. Now, what I've been reading online is a lot of people are saying that employers are waiting to see what's going to happen in the election to determine what they want to do in the job market, which is why I've been kind of seeing this freeze in the job market, where employers don't know what's going to happen with interest rates. They don't know what's going to happen in the economy, and so they've kind of put a pause on hiring new people, laying people off, and making these big changes because they don't know what's going to happen. And that might make sense for certain companies, not every company, because if your company might have to face a new tariff, your company might have to face new changes in where you manufacture your products, then sure, it can impact your company in that way. But if your company works solely in the United States, then it probably does not affect you. But what we do know is that the job market has been going through a shift where employers are not necessarily hiring more people, but they're also not necessarily laying more people off, where it's kind of this holding game where a lot of employers are just trying to keep their good talent, but they don't want to have a bloated roster on their payroll. Where if they're seeing more and more people that are not doing the work, they're not doing the work adequately, or they're not productive, then they might let you go, but they're not putting up with the same kind of quiet quitting as we saw happen before. And then the third thing that I want to talk about here has to do with the housing market, because kind of what I've been mentioning is, although the Federal Reserve Bank has been cutting interest rates, mortgage rates have been rising. Now, I did a full video explaining this a few days ago, but the reason for this is because the 10-year yield has been rising. And as the 10-year yield has been rising, mortgage rates have been following. And as mortgage rates have gone up, the cost to own a home has gone up as well. Because now if you're going to borrow money to buy that home, it's going to have to cost you more dollars in interest. Here's what Redfin said about this. Redfin says that home buyers have lost around $33,000 of purchasing power in just the last 6 weeks. Why? Because if you wanted to go out and buy a home in September, you would pay less dollars in interest. What they said on Redfin is that in September, a typical home buyer could afford a $475,000 home. Today, with mortgage rates jumping up, that same home buyer can only afford a $442,000 home because the mortgage rate on that home has gone up so much. That's why we're seeing a big bounce in the housing market in the opposite direction. September, the housing market kind of woke up. Mortgage rates fell. We saw mortgage rates fall a little bit below 6%. The 30-year mortgage rate fell a little bit below 6% in September. But then after the Federal Reserve Bank cut interest rates and said that maybe they won't be as aggressive with their interest rate cuts, we saw the 10-year yield begin to rise. Maybe it rose because people are worried about the economy. Maybe it rose because people are worried about the national debt or the national deficit. Maybe it rose because people are worried about inflation. But in any case, we saw the 10-year yield rise, which then led to mortgage rates rise as well, which then impacted the housing market. And so you have a lot of realtors, a lot of mortgage bankers, and a lot of professionals in many other industries as well that are holding their breath, wondering what the Federal Reserve Bank is going to say next week, because not only are they hoping that the Fed is going to cut interest rates, they're hoping that the Fed is going to promise more aggressive interest rate cuts after that. Now, the interesting thing about this is that the Federal Reserve Bank meeting, it comes right after the election. And while the Federal Reserve Bank is called the Federal Reserve Bank, they're not federal. It says so on their website, which means they should not, keyword should, not be affected by what's happening in the White House. They are supposed to be an independent organization. However, although they are a quote-unquote independent organization, the person in the White House, the president, has the power to fire who is the chairman of the Federal Reserve Bank. So although they're not federal, you have to imagine that there's probably some sort of influence to some extent by who is in the White House. It's not supposed to be that way, but we're talking reality here. We're not living in La La Land. Now, that being said, you have some people on the internet who believe that the Federal Reserve Bank may make a political decision. What does that mean? Well, they may be more inclined to cut interest rates if one person is in power versus the other. I don't know what is going to happen, but many people are keeping their eyes on the Federal Reserve Bank because of that. But this is where another thing you want to think about is, should the Federal Reserve Bank be cutting interest rates? Because when you cut interest rates, you make borrowing cheaper. That's what cutting interest rate does. And the goal with cutting interest rates is to stimulate the economy. So you make borrowing cheaper, that way more people can go out and put money in their credit card. They can put more money on their home equity line of credit. They can go out and borrow more dollars to buy a home. They can go out and borrow more dollars to buy a car. And also businesses can borrow more dollars to invest, institutions can borrow more dollars to invest, and governments can borrow more dollars. But the question is, do we want more debt? Now, our economy runs on debt. We have $35 trillion worth of national debt. Our economic system runs on debt. But do we want to continue inflating that debt bubble? And that's the question you will want to ask yourself, because you're going to see both sides of the answer. Now, I'm not here to tell you what to think. I'm just a random guy on YouTube, but I'll kind of tell you what both sides of the answer are. Yeah, one side would say the national debt doesn't matter because the government will never pay it off. It's just a made-up number, and we are the strongest economy in the world, so inflation really is not that important, and it's not really going to affect us because we're never going to have those types of issues because we are the strongest economy, we are the strongest government, we are the strongest military, and so even if we keep printing more money and creating more inflation and keep racking up our debt, it's not going to make that much of a difference. Then you have other people that say, yes, we are the strongest economy, but we might not always stay the strongest economy. And if we continue printing money and going down this route, we're eventually going to hit a tipping point, and that's going to put us into a deep recession or potentially even hyperinflation, which is why, yes, we do need to care about our national debt while we need to care about inflation. You can decide and pick which side you want to be on, but this is where many people have differing opinions as to what they want to see happen with interest rates. Now, higher interest rates are good for people that have cash. Lower interest rates are good for people that want to borrow debt. If you have cash in the bank, higher interest rates mean you get a real rate of return on your money. And generally, higher interest rates pull asset prices lower. Because if you need more debt to go out to buy an asset, and the debt is going to cost you more dollars, you're going to need a better rate of return to buy this asset. So generally, higher interest rates pull asset prices lower, which is why many investors who own assets like to see lower interest rates, because lower interest rates can inflate asset prices. Lower interest rates can also make the inflation problem worse. They can also stimulate the economy. And so now let's go back to what I was talking about in the beginning of the video. The Federal Reserve Bank likes to take a look at inflation and economic numbers when deciding what they want to do with interest rate numbers. And we just got two reports. One said that inflation came in a little bit hotter than expected. The other said that our economy is still growing very fast. Now, the Fed generally would want to cut interest rates as a way to stimulate the economy and as a way to continue boosting inflation. But if inflation is still high and the economy is strong, do we need to keep cutting interest rates? And yet this is where the Federal Reserve Bank and Wall Street say inflation isn't a concern. Inflation is always rated as 2%. And because of that, let's keep stimulating the economy, let's keep stimulating the job market, and let's keep moving this machine forward. So this is what you want to pay attention to. Now, at the end of the day, you can't fight the system, but you can learn the system. And you can learn how to build wealth despite what's happening in the system. Because we know that markets move up and down. We know that asset cycles happen. We know that the economy moves up and down. There will be a recession. Nobody knows when. But there will always be opportunities if you can identify those market shifts. That's what we cover in Market Briefs Pro. Again, if you want to learn more about that, you can check out the link in the description. My Market Briefs newsletter is free. It's a daily report of what's happening in the markets. You can also join that by clicking the link down in the description. But this is where, if you want to be able to find the best opportunities and win, you got to learn how to win no matter what's happening in the economy. And that means you got to invest in your financial education and learn how to invest your money, because our economic system is designed to benefit the investor.